Hey everyone, and welcome to our Masterclass series. My name is Suja, and I am the founder and principal of Lux Capital Investment Group. And we are a private equity investment firm, and I'm passionate about helping everyday investors learn how to leverage real estate to diversify their portfolio and gain financial steadiness and really plan for their future, and also build cash flow so that you can do whatever it is that you want to do today rather than in 30 years when you retire. And so our motto is private equity for the people. And that is what I'm really excited about, is bringing this wealth building model to everyday investors. So today we are going to talk, the main focus of what we're going to talk about today is how to review an investment summary. So looking at how to decide in 10 minutes if you want to do further inquiry into a deal. I'm not saying you're going to know within 10 minutes whether you want to invest in a deal or not, definitely not. But you want to be able to sort of quickly be able to assess the deal and decide whether it deserves more attention from you or not, whether you want to look into it further, whether you want to watch the webinar, whether you want to do some of your own due diligence on the market or the sponsor, etc. So that's the main thing we're going to cover today. And before we do that, I'll just go over one of the biggest myths that investors tell themselves when they think about getting into syndication investing. And that is, I don't have any control. And this mindset can keep many investors sidelined from investing in real estate, especially people who are used to being active investors, meaning who are used to buying rental properties and managing them themselves, or hiring a property manager to manage them. People who flipped houses before, people who have small duplexes that they rent out. That there's definitely, I'm all for that. Active investing is a beautiful thing. The thing is, you can either make money on your money, like with passive investing, or you can make money on your efforts, like with active investing. And one of the beautiful things about passive investing is that you are relinquishing not only control, but you're also relinquishing or handing over responsibility to someone else. So a passive investment is a way for you to make money on your money rather than make money on your effort. And I'm an active investor. That's how I started, and I'm still very much a proponent of that. However, I want to put as much into passive investing as I can, so that if I ever don't feel like doing my active investing business, today we're replacing a water heater. I've replaced like several toilet seats in the last few days. I mean, it's just endless once you start to own properties for a long time and have many of them. The amount of maintenance and upkeep and, responding to guests. I have Airbnbs. It just really, it can add up. And, I'm probably not going to want to do that for forever. So that's why I'm really passionate about passive investing. Just to quickly go over my story, I started investing in 2010, and I've done many different things in real estate, from working for large institutions to flipping to house hacking to Airbnbs, and now to investing in real estate syndications and opening a private equity firm to help other people do the same. And we have so far in 2 years invested in over 37 properties, primarily self-storage, but we've also now done 2 multifamily deals. And we're also looking to expand to other asset classes like mobile home parks, industrial, senior housing potentially. And there's a couple others that are on the tip of my tongue, but I can't quite remember them. Mobile home parks, self-storage, industrial, co-housing. And yeah, that pretty much covers it. We've got over 250 verified investors, and we're proud to have over 40% repeat investors. It just means a lot to us to know that people are having a good experience with us and want to come back. Here are just some quick stories, pictures from the last year, visiting, doing due diligence, starting my podcast, which you should definitely tune into. It's called Passive Income Unlocked, visiting sites, watching the construction happen, etc. So we're going to just do a quick review of the 4 tenets of our investing philosophy. Okay, so when I think about why it is that I love real estate syndication, these are the 4 tenets that are somewhat unique about real estate investing. And so we're going to talk about that right now, just as a review. So number 1, capital preservation. So capital preservation is a wonderful thing about real estate because why? It's backed by a hard asset. Your real estate investment is backed by a building and, it's on land. So whereas, for example, the stock market can go to zero tomorrow and it's very volatile. And so when you're talking about capital preservation, like you get to a point in life, especially when you get older, but also when you're younger, where it really is going to make a huge difference to your retirement if you end up losing 40%. Like if you wanted to retire in 2008 when the stock market dropped by 40%, that vastly changed the trajectory of your retirement. Like maybe you weren't able to retire just then, or what your portfolio was going to produce on a monthly basis went way down. And so capital preservation is really important. It's one of the reasons why I like investing in real estate. And, Warren Buffett's number 1 rule of investing, many of you have probably heard it, but it's don't lose money. And then number 2 is don't forget rule number 1. So that's why number 1, capital preservation, is one of the best reasons to invest in real estate. Okay, number 2, cash flow. Real estate investments provide passive cash flow. There are different types of real estate investments that will provide different levels of cash flow. And so depending on your needs and where you are and what kind of passive investing you want to do, do you want a lot of income? Are you going for growth or appreciation? Or are you going for cash flow today so that you can buy back your time and not have to work a job or whatever it is that you want to do? So those are kind of the 2. There are varying types of cash flow offerings that real estate syndications can provide. Some real estate syndications provide lower cash flow during the whole period and higher appreciation on the back end. And some provide higher income during the whole period and less or no appreciation on the back end. And we're even in an ATM deal where it's just extremely high cash flow for 7 years, but then you don't actually get your principal back at the end in one lump sum payment. So there's definitely different structures to know, but cash flow is one of the things that can allow you to actually decouple your income from your time, which means that you don't have to be tied to your job or your full-time job. You have more options available to you, which I always just like to remind people that even if you love your job, there may be a time in life where you want to scale back because of family reasons, or because there's someone you love that you want to take care of, or maybe you're just tired and burnt out of working, or maybe you want to pursue a new career. So you don't necessarily have time to work at your current job. So that's why it's so great to have options. Okay, number 3, the 3rd tenet of our investing philosophy, appreciation. How to tell. So these deals, one of the reasons we like real estate is because real estate values almost always go up. Land is finite. And yes, there's definitely swings in the real estate market. But if you are smart about your investment, it's going to continue to appreciate. If you take care of your investment, make sure to invest back into it, and that the deal pencils, then you're not just going to collect cash flow, but your capital is going to appreciate during the life of the whole period. And number 4, tax benefits. So this is something that's also unique to real estate. You don't get these same tax benefits when investing in stocks or mutual funds, etc. So this is about a mindset shift. The tax code is actually an incentive structure that the government has created because they want people to take certain actions. They want to incentivize people to invest in real estate. Why? Because it builds up our country. And so if you actually try to look at the tax code as saying, okay, this is what they want me to do, they're trying to incentivize me to, buy a building and renovate it, or, and I can depreciate. You can use real estate depreciation as a tremendous way to actually leverage tax benefits. And so I'm not going to go into extreme detail right now, but the main point is that real estate is a strategy. Real estate is a wonderful way to lower your tax liability. And the reason that why, you shouldn't feel bad about it is because the government has created this tax incentive, this incentive code, so that because they want us to build up our country. Okay, so that's the 4 tenets of our investment philosophy. And I'm now going to just quickly review the 3 secrets to control. So yes, once you hand over your money, you have very limited control over what happens with the deal. Although, of course, there's always should be an open line of communication between you and the sponsor, and they should take in your feedback, etc. But you're giving over your trust to them, and you do have limited control once you invest. However, before you invest, the 3 main pieces to look at are the operator, the market, and the deal. And today we're going to talk about, mostly we're kind of going to talk about the deal. So let's dive in, and we're going to go over a most recent deal that we went over, that we released, and try to, first we'll say like, okay, this is what you're going to look for, and then we'll kind of practice and do it. And please, at any time, feel free to go ahead and put questions in the chat. John, welcome to the masterclass. I saw you just hopped on, and we will continue on. Okay, so how to get a basic idea of an investment when you look at the investment summary. So that's the main deck. Usually there's a PDF that's provided to you that is going to summarize the investment offering. It's not going to have all the backup documentation, but it should have a lot of the information you need to kind of wrap your mind around what it is that's being presented to you. So we'll just go over this and then at the actual deal. So you'll want to look for the executive summary, and that will be the best summary of the deal. It'll talk about the returns, the business plan, the loan, and how the deal is structured in terms of LP and GP. And LP stands for limited partner, GP stands for general partner. And limited partners are the investors, who are, another word for them are silent partners. And they're also you basically give over, you invest in this deal, and then you become a silent partner. So you don't have responsibility or liability related to the deal. And then you also have given up some of your control over the deal. Now the sponsor is spearheading the deal, the general partner is spearheading the deal. Okay, so why are these important? The loan, as I've harped on many times, and if you listen to any of my content, you'll know that the loan is really the most critical piece when it comes to making sure that there isn't a huge negative consequence in a real estate deal. If you look at when real estate deals go bad, because obviously they have gone bad in the past, they've created a lot of heartache for many people. Many people have lost their shirts with real estate. It's true. And why is that? You can almost always trace it back to the debt structure. Okay. And so that's why it's so important to really understand debt, have respect for it, because it's also one of the ways we make money in real estate. And it is one of the ways that, and so understanding that is really important, and that should be in the executive summary. Okay, next, there will be the investment offering. And this will be the sponsor's perspective on why this is a good deal, what their plan is, and, sort of a summary of what they're going to be doing. The next is going to be the property overview. So just understanding what exactly is on this piece of property that you're looking to buy. What do the grounds look like? What kind of amenities are currently existing? What are the units look like? What is the unit mix? So kind of just a property description and understanding what is actually on the ground on the site that you're purchasing. And then there will usually be another section that's the financial. There should be a section that's the financial analysis. And this is where there will be cash flow projections. You should find rent and sales comps, which are important to kind of understanding whether you're buying right. More information on the loan. And there should also be a sensitivity test. And so sensitivity tests are something that we use when we're underwriting deals to see how sensitive the deal is to things that move, right? Like we don't know exactly what the cap rate is going to be when we want to sell. And so how sensitive is the deal to moves in the cap rate? And if you don't know what a cap rate is, just a quick review, it's that's generally a measure of the market. So what a property will sell for based on their net operating income. So, we go into that in detail in other webinars. So I won't go into more detail on it right now, but it is a really important thing to wrap your mind around. And you definitely want to look at a sensitivity test related to the cap rate. You also probably want to look at a sensitivity test as it relates to rent growth and some other common metrics, which, we'll go over at some point, either today or at another one. And then there will also be a market overview, right? So we talked about how the sponsor, the deal, and the market. And so the market overview should talk about the MSA, so the major metropolitan area, but then also the submarket, why the specific area where the subject is located is like all about it. Is it a good area? What are the drawbacks? What are the benefits? And, when you're going over these investment summaries, you kind of want to get a sense for what kind of tone is the sponsor using when they're selling or presenting this deal. So I'm a big proponent of measured investing, not hype investing, right? Like I don't necessarily want to get people super hyped up. I mean, you have to get people excited enough so that they make a move, but I'm not trying to get everybody so amped that they're like, oh my God, I have to invest in this deal. No, I want people to make good decisions about where to place their capital. And so when you're looking at an investment summary, try to judge what is the tone of this investment summary. And different sponsors will definitely have different tones. The deal that we're going to look at today has a very measured tone. You'll see it's like, we're not trying to make big waves with this property. We're just trying to execute a simple business plan in a good, strong market. And we're not overselling the deal. So, another thing that I didn't mention here is there should be a section on the sponsor track record. How have they performed in the past? And what kind of comfort does that give to you to be able to, that they can execute this next business plan? Okay, so 5-minute checklist. So this is just like how to kind of wrap your mind around the investment summary. What is the asset class? Is it self-storage? Is it mobile home parks? Is it multifamily, etc.? How many units? How big? There's economies of scale that comes with investing. So if you invest in usually over 150 units, then that's a good number. That's not to say that money can't be made investing in less, but it's a different philosophy. And there's reasons why, smaller operators, there's less competition from institutional investors for under 150 units. Okay, what is the equity multiple? You'll want to look at that when you're understanding the deal, because you want to understand, well, what is the sponsor projecting they're going to give to me, right? And we'll go over that in some more detail. But basically that says if you get 100,000, if you put in $100,000 and then you get back $190,000 in 5 years projected, that would be a 1.9x equity multiple. Okay, what is the internal rate of return? So the internal rate of return, which we talk about frequently, is a return metric that takes into account the time value of money, which is one of the most important concepts to understand in finance and real estate. Real estate investors want more liquidity now so that they can invest it in deals so that their money can grow faster. This is like the most important thing that you can understand about real estate, is that you want to start investing now so that you can take advantage of the time value of money. Because if you wait to invest, then time is going to pass and you're going to lose a ton of value. Okay, number 5, what type of lending is it? Is it a agency debt? Is it a bridge loan? I know this is a lot of jargon, and over time you'll start to pick up on this on the lingo and what it means. How long is the interest rate fixed? So, you might have heard of adjustable rate mortgages, for example. Well, we want to know how long the interest rate is fixed, because there's definitely interest rate risk, especially today. I mean, we know it's January 19th, 2022. We know that the Fed is probably going to increase rates. I think they said 4 or 5 times this year. And so are we buying a property where the interest rate is fixed or not, right? Because if we're not, we need to be really careful about how we're projecting increases. Number 5, what is the reversion cap rate? This is, a hot topic for investors. You want to know, well, how conservative is the sponsor being? Because the reversion cap rate, which is the cap rate when you sell the deal. So usually in an underwriting, you'll have the cap rate at which you purchase the deal, and then the cap rate at which you sell the deal. And the cap rate at which you sell the deal can drastically change the projections. And so how conservative is the sponsor being? And one general rule of thumb is that it should increase by 0.1 for every year of the hold period. So if you start at a 4 cap and you purchase it at a 4 cap and you sell it in 5 years, the reversion cap rate should probably be at least 4.5%. And if not, inquire further. Rent growth is another really important metric. So, usually we're looking at 3%. There might be cases when 4% is justified for a stabilized rent growth in a really hot market. But, typically we're looking at more along the lines of 3%. If it's kind of a market where, there isn't a lot of population growth, then definitely looking at probably 2%. And then projected vacancy, we want to see that, between 5 and 10%, typically economic vacancy. Okay, so here's a little chart that can be used. You can refer back to this to just kind of assess the overall deal. And, it's not necessarily, it's not like everything has to be in this ideal category, but, it's just a good way to kind of measure it. And why are these the ideal ones? So asset class, B or C. So, I said, is it self-storage or multifamily, but also within those asset classes, it can be class A, B, C, or D. D is basically a lot of crime. C is not that nice. B is pretty nice. And A is like really nice. And we like B or C. Why? Because it's a very protected position to be in. There's upside. So we can, when the economy is doing well, people will move up from the class D properties to class B or C. And if the economy is going down, people will move down from the A properties to B or C properties. So we think it's really well positioned for it from a downside protection standpoint. Number of units. So we talked about this a little bit. More than 100, you're going to benefit from the economies of scale. However, I interview a lot of sponsors, and there are people who they really like to play in this 50 or somewhere around there unit. And why? Because there's less competition, right? And if you have to be able to escape competition to be able to, if you're a small player, you don't necessarily have, you have to be strategic, right? And so there's definitely money to be made, but you want to check it out, right? Okay, equity multiple. So ideal is near 2x for a 5-year hold period. But it's also really important to make sure that the sponsor isn't overselling the deal. And so, definitely take this with a grain of salt. You want to make sure that this number, this 2x, is very supportable. And you want to make sure you look at the sensitivity analysis. And also, there's great deals out there that are more like a 1.8, and on a 5-year hold period. And those deals are probably stronger on the capital preservation side. So, there is always a risk return curve. Okay, internal rate of return. So, if it's 16%, that's really, really good these days. 14, 15 is still very, very, very good. And lower than 13%, then you want to make sure that there is very low risk with that. And so certain types of deals might be better for you, right? If you're more interested in capital preservation, then you're probably going to get then maybe a deal where it is 13% or lower is the best option for you. So it's not to say that it wouldn't be a good deal, but you have to know your priorities and understand exactly where you're at. I'm in a growth phase. I'm growing my wealth. So I definitely want to be more aggressive and look for deals that are closer to this type of loan. Okay, so we touched on it a little bit, but just to actually talk about it. So ideal non-recourse agency debt, Fannie or Freddie. Again, this is ideal in certain circumstances. In some circumstances, you may be happy with a bridge loan because it may give you maximum flexibility. Because while non-recourse agency debt is really good, long amortization periods, and the interest rate is fixed, they're non-recourse. So as long as you do everything correctly, then they're not going to go after the principals. However, there also could be large prepayment penalties attached to these types of loans. So in some cases, a bridge loan could provide the maximum flexibility if you're having a sponsor that's looking for a quick exit. So, I would say that take all of this with a grain of salt. The most important thing is to understand the strategy, but you can use this as a tool. Just make sure you understand it. Okay, so what is a good loan interest rate? Fixed for 7 to 10 years is ideal. However, you also have to balance that with prepayment penalty if you are thinking about doing a quick exit. Reversion cap rate, we talked about that a bit. 0.1% per year for every year of the whole period. Market rent comps, multiple comps are higher than the subject property. Okay, so looking at rent comps and sales comps is extremely important. We want to make sure that we're not the top dog in a market, right? Like we want to make sure there's people above us and also people below us. By people, I mean properties. So are there properties that are renting for higher than the rent that we are, comparable properties that higher than the rent that we are having in our pro forma. So that is the rent comps. And then we also want to make sure that we're buying at a good basis. So we want to look at other sales comps and see like, okay, per unit, how much did they pay? $150,000 per unit? Did they pay $190,000 per unit? And what are we looking to pay? And how does of course you have to look at how do the interiors compare, how do the exteriors compare. You want to make sure that everything that you're looking at comps, and that can be challenging to finding good comps is challenging. So it's always a bit of a puzzle that you're kind of trying to put together. And projected rent growth. So again, most conservative is less than 3% per year if it's in a growing market. If it's not in a growing market, 2% per year. 3 or 4% can still be justified. And vacancy we went over. So 10% per year is ideal when, you can feel really good about that if that's in the projections, but 5%, 10% per year may be warranted based on the market, et cetera. Okay. So now we're going to go over a recent deal that we currently have out and just kind of go through the exercise. Okay. So here we are. I'm going to scroll to the top. Okay, so say you're looking at this for the very first time. Okay, so here's the first page, disclaimer. There's always going to be a disclaimer. Here's some images. And then I like to put the returns up front because people are very interested in their returns as that, I always want to see the returns. I usually flip to the back of the investment summary and look at the returns first. And so I just put them up front because I think it's important for people to understand, what the projections are. And so we'll come back to this, but I always put it up front. And now we're going to look at the sponsor section. Okay, so here is the sponsor section. The sponsor of this recent deal is Lone Star Capital. And, here's a little bit about them. They are vertically integrated. They have a property management firm. I'm also presenting this deal. So a bit about me. It's a bit about the principles. So you can wrap your mind around who exactly is doing this. And then we have case studies, right? So looking at the sponsor's track record. Brand is at Bear Creek, a couple case studies. This is really great. There's links to case studies and a little blurb about different properties that they've turned around, and some testimonials. And here's the track record, right? So this is all about evaluating the sponsor and seeing like, okay, well, what have they been able to deliver? In this case, you can see these are properties that they've acquired. And then these three right here, which have like a sold date, these are the properties that have been sold. So all of these other ones are properties that are that they're either acquiring or hoping to acquire. So the blue ones are the ones that had not been acquired yet when this was made. And then here you can look at the IRR that they returned to the investors. So they were able to return a 69% IRR, 29% IRR, 29% IRR. And then you can see how long it took them to deliver that. So it took them under 2 years in all of these three cases. So of course, you want to verify that. You want to make sure you trust the sponsor and that these are accurate numbers. But it's a good way to kind of get a sense of like, okay, this is what they've accomplished so far. And, what we could, obviously past performance is not an indicator of future performance, but it is good to look at a track record just so you could have more comfort that someone has been through this before. Okay, so now here we are. So just to go back to our checklist, we're going to look for the executive summary. So here is the executive summary. It spans these 2 pages. And, we're not presenting the deal exactly, but we'll just pull out a few things. So we are looking at, this is details of the deal, when it was built, its location, current occupancy, 97%. So it's got really strong occupancy, where it's located. It's some information about the property. And then here we have the returns and the business plan, and some more information about the financing. So, we went over the returns. The returns were and another, the returns, what we're looking at, cash on cash, IRR, etc. And then, so there's another returns page, which we'll get to in a second. But this is a general overview. And so now we're going to look at the loan. So on this page to talk about the loan. So they're getting a loan for $26 million. It's a bridge loan. Here's the lender. And what is the LTV or LTC? 80%. So, there's lots to talk about here. We don't have time to go over all of it. It's already 12:40. So, but we'll just pull out some different things. So the term is 3 years plus a 2x 1-year extensions. So what this means is that the interest rate is fixed for 3 years. And then they are able to extend for 1 year at a 0.25% increase in the interest rate for each of those years. And, this isn't here, but I know one thing to inquire about is, what would the prepayment penalty be? And in this case, after inquiring further, I found out that it's just 18 months of interest. So as long as they hold the property for 18 months, then there would be no prepayment penalty. And even if they did want to sell before 18 months, like say they wanted to exit in a year, then it would just pay 6 months of the interest. So, and it's interest only. So that's a pretty flexible option. They like this option because it still provides them some certainty, right? Like they know what their interest rate's going to be for 5 years. And they also have the potential to sell with very little prepayment penalty. So that's just a little bit about the debt, which is an important topic. And I always like to talk about that. Okay. And so, just an overview of the business plan, etc. So then the next thing we're going to look for is the investment offering, recap of why it's a good deal. So here, here's the returns section. And it also talks about, it's kind of like this talks about the structure. So thereafter excess proceeds are split 90% to the LP and 10% to the GP. So that talks about the waterfall structure. Again, we don't have time to go over all of this in detail, but this is where you want to look to understand the structure of the deal. And here are the cash flows of the deal. Again, here is the waterfall distribution. And here's some more about the returns, right? All in here, you've got the IRR, the project level IRR, and the investor level IRR. And so that's the investment offering. Okay, so then next is a property overview, and you want to see, well, what is their plan? In this case, they've put like a picture of what it looks like and what they want it to look like, what they're going to renovate it to. And they described exactly how many units they're going to be refinishing. So 137 units are like this, 95 units are like this, and then they're going to make them all like this bottom picture and the one to the right. And they've actually laid out their plan very clearly, which is great. Install washer dryer connections in all units. Whenever you can do that, you're immediately adding at least $50 to the rent price, because tenants really value that. Okay, so we're gonna look at the grounds overview, information about the building itself. And so this is more about the property. And then we're going to go into the unit mix. This is an important tab to kind of, once you get kind of nerdy about this, you can start to really dive into the unit mix and understand, like, okay, well, what different types of units are there? What's the difference between a 1x1A and a 1x1AR? And I mean, it doesn't say it here, but you can ask and figure that out and understand, like, okay, well, that we're going to command a rent premium for these 1x1 ARs. And you don't necessarily have to like dive into this, but the information's there for you if you want to. And then you can look at this average, which is really helpful for when you're comparing it to rent comps. So, this is not, we haven't gotten to the comparing it to rent comps yet. This is just the subject. Okay, so the next, it looks like they have switched and they've done the market overview before the financial analysis. So now here is the Northwest Houston submarket. And in this particular investment has decided not to do the MSA and just to focus on the submarket. And so that's something you'll want to take note of, but they do talk about rental growth trends, which is important when you're actually trying to say, okay, well, are their rent growth assumptions reasonable? And then you want to see, okay, why is this area unique? Why do we like this area? It's close to the airport, but not too close. It's on a very busy street with 50,000 cars per day traffic count, which is really, really, really attractive. Actually, it's a very busy area, but it's tucked away and it's got a lot of green space, the property. So that makes it very appealing. And it's near a lot of employment centers like an Amazon warehouse and retail. So looking at the subject market and really just understanding, where is this property situated? Is it in a desert, or is it in a convenient area that already has like a strong neighborhood around it? So that's important to understand when you're looking at the market overall. And then now we're going into the rent comps and the sales comps. So we're going to breeze through this since we're running out of time, but I wanted to just point out that this is where you do want to spend some time here as you get more, as you really, maybe not in the first 10 minutes, but once you decide, okay, this is a good deal, then you want to spend some time in this section and maybe even do some research, right? Like actually check out these other comps. But first, just understanding this and saying like, okay, where do we sit, right? So like in this case, Park sits at, and you can just look at this average, like going in 127 per square foot. And so is that on the low end or the high end? And you can see there's several properties that are above it, and there's one that's below it. And so that's good. It means that if these are actually good comparables, then we're in a place where there's a lot of room to go up. And so then we're actually are planning to go up to 145 per square foot. And so are we going to be the top dog? And so there is Northgate Oaks is still there at 1.53. And this is going to happen over a few years. So it's possible that some of these other ones will creep up, like this one might creep up over well, but we're not going to be the top dog. So that's important. And then you can also, that's just for the 1 bedrooms, but you can look at it for the 2 bedrooms and the 3 bedrooms as well, which are 50% of the property. And then looking at the sales comps, right? So this is where you're like, are we buying this property at a good basis? And so we're buying it at a basis of $131,000 per unit. And you can look at the average and that's helpful, but it's also with the sales comps, it's really good to really understand the other ones in which are really good comps. So for example, Round Hill, it's a lot higher, but it's also a lot bigger of units. And so not necessarily the best comp, but it's not the worst either. So understanding sales comps is kind of like the next rent and sales comps is next level. But I wanted to just give you guys an overview about it because it is important. And then we're looking at the pro forma financials. So this is saying like, okay, well, what are we actually projecting the cash flow to look like? And we're going to do a whole nother section on the pro forma financials because there's just too much to actually really understand here. But the basic is that we're looking for the net operating income, and we want to see, well, is the income supportable? Are the expenses supportable? And this is actually really the heart of the whole deal. And so we're going to spend some time on that. One quick thing that you can look at is the operating expense ratio. Usually around multifamily properties, 50% is a rule of thumb of like, if you see it creep too low into the low 40s or the high 30s or even 30%. I mean, I've seen properties underwritten at a 33%. And that was just, that's too much. That's too aggressive. So you want to ideally see it hovering somewhere around 50%, which it is in this case. And then CapEx budget. So we want to see what are they spending money on, right? And is this supportable? Is this defensible? In this case, the sponsor works in Houston. They have relationships with vendors. They have their pulse on the market. They know if pricing is changing. And so they have a very good idea of what their CapEx budget is going to look like. They've walked every unit. So that's, all of these little details really add up to say like, okay, is this business plan defensible? And here we've got a sensitivity analysis. So in this case, we've looked at the sensitivity as it relates to rent growth. As it relates to the exit cap rate and so we've taken rent growth and the exit cap rate. So those are the two variables that we're comparing. And then we want to see what's the average annual return sensitivity and what's the equity multiple sensitivity. And so, this is our pro forma, what we've chosen. And these are the, we're at about a 1 point. So this is how we get to this 1.52. But if we do, if things go poorly, then we might be at a 1.47 equity multiple. And if things go, like if rent actually grows 2% per year instead of 3%, then we would be at 1.47 over 3 years, which is still really not that much, right? So you're seeing that it's not super sensitive to rent growth. So that's a good thing. Like if you can adjust it. But anyway, so the sensitivity analysis is like something that is also something to spend some time with. But I want to just touch on it right now so that you can get a sense of how it fits into looking at a deal in 10 minutes or less. So I think that is actually it for this particular presentation, going over this 5-minute checklist, this 10-minute overview. So I would now like to just see, did you guys learn at least one new thing or were reminded of something? Do you have any questions? So please pop them into the chat and we will go to the FAQs.